For nearly 10 years, Cameroonian Cecil Mambo has run a trade business in Nigeria, helping to strengthen commerce across Africa. But a new tax law is threatening her business. Under the regime, she would surrender up to 20% of her earnings, almost triple the entry-level pay-as-you-earn rate of 7%. For her, the changes come with a heavy cost.
We are already paying so much taxes. We are paying for quota of expatriate because in our company we have other expatriate working for us and I'm an expatriate. We pay quota every 2 years and it's not small amount. I pay for resident permit $2,000 every year. It's quite a lot.
The tax hike is embedded in Nigeria's 2025 Tax Act, which comes into force in January 2026. It replaces older regulations, expands the tax net, and is expected to generate trillions of naira in additional revenue.
The idea of the reform is, one, to enhance revenue generation, to improve the quality of tax administration in Nigeria, to improve the level of compliance to tax payment, to be able to simplify the tax process and make Nigerians begin to see the impact and benefits of paying tax. If you are a Nigerian and you are making money in Nigeria, it's 10%. So for foreigners, 20% is not so much money compared to the kind of revenue they earn here.
Nigeria is pushing to strengthen its role as a continental trade hub under AfCFTA. Expatriates bring vital skills and capital, but business owners argue that raising taxes could damage investor confidence.
We are in an era where we are trying to promote investments across Africa. It just seems to be more of a burden. How are we saying we are encouraging more investment in Nigeria, but at the same time, we are trying to increase taxes. So I feel there's a need to look into it again and see how best we can incentivize the people that are ready to do business here, because we are also creating employment here.
This tax reform comes at a time when Nigeria is under pressure to diversify its revenues away from oil. Many worry that without better infrastructure, simpler regulations and stronger legal frameworks, the higher rates could fuel capital flight rather than attract the investment the government hopes for. The government says over several years, Nigeria has lost billions through exemptions and untaxed foreign income. Economists insist taxing expatriates is standard practice worldwide, and with a right business climate, it could even boost investors' confidence.
What promotes investment is creating an enabling environment for their businesses to thrive. If their businesses to thrive in Nigeria and they know they are going to earn enough revenue, they are willing and ready to comply. What scares them away is that porous business environment they continue to find themselves.
As the January rollout nears, debates over double taxation, investment incentives, and foreign confidence are intensifying. The government has yet to disclose its revenue targets, but for expatriates, the key question remained whether this is a financial burden or a step towards a more inclusive growth strategy. Kelechi Emekalam, CGTN Abuja, Nigeria.